Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 159 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So, common theme, Matt is traveling out of the office for work this week, so I have Nick Whitaker back on with us, our Director of Research and Trading. So welcome back, Nick.
Good to be here. Coming off the bench again.
Yeah, coming off the bench. So good to have you back as always. So let's just hop right into it, I guess. Before we begin, just want to take the first few minutes to recap the performance of the month and the year of the major indexes that we track. And these numbers are as of the market close on July 20th. And this data is from YCharts. S&P 500 index up 4.6% for the month of July and down 16.9% for the year. The Dow up 3.6% for the month and down 12.3% for the year. NASDAQ Composite Index up 7.9% for the month and down 24% for the year. The Russell 2000 Index is up 7.2% for the month and down 18.4% for the year. And the Vanguard All World X US ETF down 0.2% for the month and down 18.7% for the year. So kind of an interesting turn of events here, Nick, at least so far through the month of July. Strength in the US markets on a relative basis. International continues to outperform. But as always, we still have a few more trading days here in July that these monthly gains could be quickly reversed. And it wouldn't be shocking since we're right in the middle of earnings season right now. And I think next week is going to be the big week for most of the major tech companies that are reporting. Yeah. So, but we'll see. Guys. I think earnings have been better than people have anticipated so far. So we'll see how that continues to roll out throughout the next several weeks. The 3-month Treasury rate is sitting at 2.51%, the 2-year Treasury sitting at 3.25%, and the 10-year Treasury at 3.04%. So if people missed our podcast last week, we talked a lot about the yield curve and the yield curve inverting. So the 2-year Treasury still having a higher yield right now than the 10-year. So that is still an inversion right now. Yep. So moving on to big headlines and current events from the week. Nick, do you want to kick us off there?
Yeah, I just have a couple here, just an update on a few major headlines. And the first thing is an article and an economic data point. Picked this up on Bloomberg yesterday, actually. It was U.S. existing home sales dropped a fifth month to a 2-year low. So contract closings fell 5.4% in June, more than forecasted. The median selling price rose to a fresh record of 416,000. And then I've got two little quotes here for you from the article. Sales of previously owned U.S. homes fell in June to a 2-year low as a surge in borrowing costs continued to erode affordability. Mortgage rates are near the highest since 2008, have curbed buyer demand and pushed some buyers to back out of deals. As inventory starts to grow, some sellers are now cutting prices. So it's a sign that we're kind of finally there in the housing market. It's starting to slow down a little bit. The demand and supply dynamics are finally kind of getting there. So, you have any comments on that?
Yeah, well, I think it's just, that's one of the things that I think a lot of people look to when the economy starts to slow down is, you really see that in housing. So that's one of the big tells is when, new home sales dry up. existing home sales dry up, that, we're kind of contracting in the economy. People are pulling back a little bit. So, this time just might feel a little more awkward, because we went from just way on one side of the pendulum to now I think we're going to way on the other side. And it was quick, right? This didn't happen like in a slow pace, right? So we went from, people buying houses like crazy, and you were battling with 25, 30 different people on offers from houses. And now it's kind of,
now we're having price cuts.
Right. So we were at this side of the pendulum where the sellers had complete control, but that's starting to swing back the other way when buyers, I think, could come in a little lower because there's not as much competition and borrowing costs are higher. So it's going to be interesting to see how this plays out. Again, I'm still in the camp that it's not going to be a housing price collapse, but I do think over the next several months and over the next year or two, you're going to see housing prices come in substantially. So that's going to provide, an opportunity for people to, get back and buy houses on the cheap, I think, eventually. Obviously, prices are still severely elevated from where they were just 3 years ago. But I think, like I said, that pendulum is finally getting back to the middle, and then it's going to start to favor the buyers, I think, over the next couple of years. So if you're looking to buy a house, next couple of years could be pretty important for you.
Absolutely. A couple more just quick headlines that I picked up. The European Commission is proposing a plan that calls on 27 EU nations to cut their gas consumption by 15% between August 15th and March 31st of next year. There's a lot of headlines going on in Europe right now, and headlines with Russia and them potentially cutting off the gas, and no one trusts Putin, and will he turn it back on, and if so, what's going to go on there. But the European Commission coming out and proposing that, I think, is just a sign of how serious it is over there. I mean, they're worried about energy blackouts, and when you're cutting energy consumptions, you got to think about the tertiary effect that has on businesses, and businesses will have to shut down, and factories can have to shut down for certain amounts of time, and things of that nature. So
and I don't think a lot of people understand that, like, rolling blackouts in some areas of Europe and some areas overseas is pretty common in a normal environment. So I know, like, places in like Lebanon, they do rolling blackouts, and it's like every day, like a couple times a day, the power will go out for a little bit, 20 minutes, 30 minutes here and there, and it's just normal to them. But we've never had that here in the US, at least for people that are alive right now. So people don't know what that's like. And obviously everything going on with Russia and Ukraine is putting more strain on that, and people are worried that they're not going to be without power for a significant amount of time. But I actually just read something this morning that Putin, at least for the time being, is not cutting off their energy supply to Europe, even amid the sanctions that have been put on them. So at least in the short to intermediate term, it looks like that's not going to be a major issue right now, but it's something to watch, because that's going to be a huge issue for some parts of Europe if he takes that further and says, hey, we're not going to supply you guys with anything anymore.
Yeah, I think it's like Russia supplies 40% of Europe's natural gas. Is that right? Something around the 40% range. The next quick little headline is again on Russia. Russia's reportedly looking to annex more Ukrainian territory beyond Luhansk and Donetsk regions. Sorry for butchering those names. Ukraine. But the two regions that were kind of the start of the war, they're looking to annex more territory around that. And then the last highlight that I have is the United Kingdom saw a 40-year high inflation rate in June, just 9.4% year over year. That has sparked calls for a more aggressive rate hike by the Bank of England at its next meeting. So a lot of the stuff that's going on in the US is also going on elsewhere. So just an update on the international side for our listeners.
Yeah, and inflation is not just contained in the U.S. right now. It's pretty much everywhere. So.
Not at all. So Moving on to tweets and articles and research.
Yeah, so I got some stuff that I think is more on a positive note than what we just kind of talked about. So the first thing I had was a tweet from Jay Capel on July 12th. And he's also known as the sentiment trader on Twitter. So he says, overall corporate insider buy-sell ratio continues to soar. Are they seeing better than expected earnings ahead, or should they be seeing a psychiatrist? So we'll have Jenna throw this up on the video for people here. And it's just a chart of the corporate insider buy-sell ratio. So when we're talking about corporate insiders, we're talking about board of directors, people that are privy to inside information. And it shows this chart of the S&P 500, and it shows the different levels of corporate insiders buying stock, right? So, you know, it's just the thinking that, hey, these people know a lot more than the general public knows. And if they're aggressively buying stock right now, are we getting closer and closer to the end of this bear market? And if you look on the chart, Nick, you know, they're buying stock at levels not seen since, you know, literally the low in March of 2020, right?
Mm-hmm.
So they almost, you know, time ticked that perfectly, you know, in terms of calling the low. And we had obviously rip roaring markets for the next couple of years. And it was the same thing back in 2016. The last time we had that sell-off, the mild sell-off from 2015 to 2016 with everything that was going on in China, corporate insiders were stepping up and buying stock. And the other thing to note is corporate insider buying was at an all-time low right around the end of 2021. So in the November, December time period, corporate insiders virtually were buying almost zero stock.
Yeah.
So it just goes to show you, and that was really right around the top of the market, right? So it just goes to show you that these people do know a lot. And this is one of the things that we track from month to month, and obviously that Jay does too. But I think it's another feather in the bull's cap that we're getting closer to the end of this, and insiders only buy for one reason, right? They're buying because they think stocks are going to go up. Yeah. They can sell for a multitude of reasons, right? They have tax consequences. They need to
diversify.
They need to diversify. They want to buy a vacation home. They want to do whatever with it. But, you know, there's only one reason why, you know, they buy stock, and that's because they're optimistic going forward over the next several years. So just wanted to throw that out there as another piece of information that we're tracking that I think is going to line up with this next piece that I have from Jeff Hirsch, which was on July 6th. So Jeff does a lot of research on strong and weak spots for presidential cycles. So we've talked pretty heavily, especially this year, about his research in the past, because midterm years tend to be the weakest year out of the 4-year presidential cycle. So in his most recent blog post, he said that the second and third quarter of the midterm year, which we're right in the middle of right now, has been the weakest period of the entire 4-year presidential cycle, averaging losses over the 2-quarter period of down more than 1% for the Dow, 1.5% for the S&P, and down 5% for the NASDAQ. But in the sweet spot of the 4-year cycle, which is the 3-quarter span from the midterm year Q4 to pre-election year Q2, the Dow gains a little more than 19%, S&P is up 20%, and the NASDAQ up almost 30%. So the important thing that I wanted to just note here, Nick, is, you know, we're going to be embarking on the strongest period for the markets in the election cycle from Q4 of this year in 2022 through Q2 of 2023. So, you know, I just think that a lot of this stuff is just lining up almost perfectly to where we get to the midterms, markets bottom anywhere between August and October, and we see a really strong finish to end the year and a really strong start to the year in 2023. And again, this could all get blown up if we have another like macro event that would just bring everything down, right? Yep. So something similar to COVID or another war.
Another black swan event, so to speak.
Yeah, but I just think, you know, things are looking up and up, and all the data we're looking at is pointing to we're getting closer to the end of this bear market. So I would just encourage people to hang in there. Again, this stuff could always change, and this could mean absolutely nothing by the time we get to the end of the year. But in my opinion, from the data that I'm reading, I think the worst of it is behind us, and I just don't want people to be more scared of what's to come, especially if you have a 3 to 5 year time horizon. So interesting research there from Jeff.
Yeah, that's a good one.
The last thing I had was just kind of a fun one, Nick. So I went back to a article that we talked about on the podcast back in like April or May, I think it was. And it was an article in the Wall Street Journal that was published on April 26th titled "Fidelity to Allow Retirement Savers to Put Bitcoin in Their 401k Accounts." And it says investment giants move could send cryptocurrency investing further into mainstream if employers decide to offer this option. And Jenna will throw this chart up there for you, but it's just a chart from stockcharts.com. The performance of Bitcoin from the day this article came out until now. So this was just a couple of days ago, this chart, so it's a little outdated. But since that article came out, Bitcoin is down almost 50% since then. So it's just
that's how it goes.
We always talk about like things getting into the mainstream, and we went through this with like the pot and weed stocks, right? So once it got mainstream and everyone was like crazy over it,
very
after
overdone
all the
trade
gains had been made and everyone was talking about it and saying, hey, should I buy Canopy Growth Company or like all these other pot stocks that were going through the roof? By that time, it was pretty much already too late, right?
So the valuations got out of control in that.
And this is just another scenario where I think it got way too mainstream, and all of the quote unquote edge out of cryptocurrency trading kind of deflated a little bit, and we saw cryptocurrency prices fall 50% and some even more. So it's just a reminder that this stuff can go up and down just like the stock market does, and they trade more like tech stocks than anything else, in my opinion. And I'm not advocating for or against Bitcoin. I think eventually it could have a place in our economy within the next several years, but you just got to be careful with this stuff, because this stuff trades 24 hours a day, 7 days a week, and this stuff can happen. So
your cryptocurrencies are on the highest risk spectrum of your investment portfolio.
And
so with that, you have to be prepared for a 50% drop over a 3-month period.
And you definitely haven't heard as much from the pro cryptocurrency crowd in the last several months as these things have gotten absolutely waxed.
As the hedge funds are blowing up and all that.
So I just thought it was interesting that it's kind of like it goes back to like the the magazine cover scenario that we talk about. It's like something comes out on the front of Barron's and it's like inflation at all-time highs. Usually it's like, okay, inflation's peaked and rolled over, they're just too late to the party. Same thing with supply chain issues. They had the supply chain issue in there, I think in the fall of 2021, and that was like the tail end of most of the supply issues and the backlogs at the ports with everything with shipping containers and that type of thing. And now it's like, hey, the Wall Street Journal came out with this article talking about Bitcoin being allowed in 401ks, and ever since that came out, it's got cut in half. So
it's funny how that's
interesting to share with people. If you're reading about something like this in the Wall Street Journal or CNBC, CNN, Fox, any of the mainstream medium outlets, typically you should have your ears perk up and be like, this is getting a little stretched and a little too far in the mainstream media. So maybe it's time for a breather. So, and it happens time and time again. It's just human reaction and behavioral investing, right?
Absolutely.
So let's hear from your boy Jonathan Farrow.
Yes, I love Jonathan Farrow. He is an anchor on Bloomberg, very, very sharp guy. This is a tweet from him, and it's about the Bank of America Fund Manager Survey and how it is showing extreme bearish sentiment. So Jonathan says the following: both a fund manager survey, and this is in quotes, "I'm so bearish, I'm bullish." Record low growth expectations, record low profit expectations, equity allocation lowest since 2008, cash levels the highest since 2001. And then there's a little chart here that shows the net percentage of the participants who were surveyed and whether or not they think a recession is likely. And it's pretty high up there, since it's the highest we've seen since April 2020. So right in the peak of COVID there. And this came out on the 19th, so just a couple days ago. And the quote he has here, "I'm so bearish, I'm bullish." That's kind of the takeaway of the fund manager survey. And I've talked about this on previous podcasts, but the BOFA fund manager survey, BOFA, again, short for Bank of America. It's just a survey that goes out to a lot of different PMs, and they survey, I think it's over like $1 trillion of assets under management across a lot of different PMs, portfolio managers, big fund managers, hedge funds, institutional money managers, et cetera, and just to get their sentiment and their thoughts on the market. So the market looks at this pretty closely, and this actually came up on one of the news sites that I follow pretty closely 2 days in a row, which is kind of shows you how interesting it is. And I think the biggest takeaway being that equity allocations are so low and cash is so high. And then we saw the market kind of ride a little bit. I think it was up almost 4% since this survey came out. And I think it's just that I'm so bearish, I'm bullish. It's just a little bit of that, where you kind of see where the market sentiment is from some of these big money managers. So
yeah, and again, I think that just adds into what we were talking about earlier, is it's almost setting up for this like perfect storm of really strong equity returns going forward once we kind of finally bottom out here. But I think the next couple of years returns are going to be really good. We're going to hopefully get this quote unquote recession out of the way that everyone has been waiting for the past several months. And again, this information in the economy is not going to get better for the next several months, but the market knows enough to sniff out when that's going to get better, and the market's going to recover before any of the economic indicators get better. So, if everyone thinks we're going into a recession and we're going to have layoffs and earnings growth is going to start rolling over and profit margins are going to start coming in, if everyone is on that side of it, which it seems like everyone is on that side of it right now, usually tend to use that as a pretty good contrarian indicator that the worst is behind us. So
absolutely. The market is always forward looking. Yes. The next piece I have is just a quick update on commodities. This is from Bespoke Investment Research. It's a research report from the 15th, so about a week ago. There's a good chart here. It's on commodity sub indices. So just a pocket of a bunch of different commodities that they kind of group together and make an indice out of it. Very similar to the S&P 500, but just with commodities. And there's 3 different commodities on here. There's commodity sub indices. There's the Bloomberg Agriculture sub index, the energy sub-index, and precious metals sub-index. So you get kind of a broad range of different types of commodities, right? They're all very different types. And then I'm going to read a couple of highlights from the report. Although this week's CPI print came in much hotter than expected, there's evidence to suggest that inflation may start to roll over. Importantly, input prices, commodities, have fallen dramatically in recent weeks. Agricultural commodities are now 20.3% off their peak, while energy and precious metals commodities are 20.4% and 20.8% off their highs, respectively. This comes as speculators begin to question the demand side of the equation due to recessionary fears. So we've talked a lot about this in recent podcasts about inflation and, is it peaking? And we talked a bit about the last print, it was in the 9% range, but the core is coming down a little bit. And I just thought this chart was a nice way to look at the commodities market and just really kind of show via a chart what we're talking about, because you tend to see that demand come back a little bit, and that's a good sign for inflation.
Well, yeah, and the only thing that's getting put in front of people's faces are all these like CPI prints, and there's no context to it. So people just think things are getting worse and worse and worse. But if you dig a little deeper, it's actually, in my opinion, starting to get a lot better.
It's coming down.
I think, their inflation is going to start to come down here quicker than people think. And again, that's just, I think, going to buoy equity prices going forward. So,
and you made this point last week about how really the majority of the inflation, the CPI print at that 9%, 9.1 or something like that, was driven by the energy and the food, the more volatile sections of the basket of goods,
right.
which is the CPI print. And when you look at this chart, and you made the comment of, you think energy will come down, and then that will kind of bring it down even further. And so this chart is just, it's a little bit leading ahead of those CPI prints. You got to think that those CPI prints are in hindsight, right? It's economic data, so it's from June. Well, we're in July, right? So
right.
it's just a little bit of a preview as to kind of what the market sees. You look at this pricing, you look at the last CPI print, you hear the Beaufort managers survey is so bearish, and you see where valuations are, and you think maybe not a bad time to dip your toe in the water. And now we've seen markets come back over the past 10 days, a pretty good response. So it all makes sense.
And I think, that made me think of this one other thing that, I follow, this one chart I have in my list that I review every week is, I kind of just label it like the business cycle, and it has stocks, bonds, and commodities on it. And typically when you're looking at economic cycles, stocks tend to peak and roll over first, then bonds, and then commodities, right? So I think we're starting to finally see, commodities roll over. And I think that'd be a good exercise for people to do if they're curious. It's just going back since the market's inception, since we started having historical data to track this stuff, is you'll find a pretty common theme of equities rolling over, then bonds, and then commodities. And then, we hit this bottom in the economic cycle before things start going back up again. So again, I know I'm beating a dead horse, but it all seems too good to be true that we're setting up to getting towards the end of this thing. So that's very interesting to me.
Very good point. And the last piece, I'll be honest, I really love this last piece. I think it's something that is not talked about.
I don't think you've not had a Compound Advisors chart or article.
I love these guys. They have great charts. They do a great job. Charlie Baleo, and Compound Advisors. I'm a big fan. So I'm sorry I'm so predictable, listeners, but it's good stuff. So I got another one from Compound Advisors, and this is from the 18th, and it's a great chart here. And this is something that I don't think you hear a lot about. I heard it on Bloomberg, but I didn't see any major articles about it. Maybe there was, maybe I missed it. But it says the research says a tale of two sales, nominal versus real, and this is about the U.S. retail sales data. It says in nominal terms, U.S. retail sales still appears to be booming, hitting another all-time high in June with an increase of 7.7% over the last year. But after adjusting for inflation, the story changes dramatically. Real retail sales peaked back in April of 2021 and are down 1.2% year over year, which is another interesting indicator to me that a lot of the retail sales data is actually driven by inflation as opposed to actual demand. So if you have demand pulling back, along with all the other things we've talked about in the podcast to this point, you can kind of see how the market has kind of come forward a little bit. When you look at that, when you look at the market thinking about, okay, a recession is coming, we're a consumer, you guys have mentioned it many times, but a consumer-led economy. And so the real data is the inflation adjusted data is telling us that it's starting to pull back a little bit.
And I think that's a good point to make for people too, Nick. So like when Nick says nominal, he's meaning data that's not adjusted for inflation, And then the real, quote unquote, real is inflation adjusted. So there's, hundreds, probably thousands of different economic indicators that you can look at based on a nominal basis without inflation or an inflation adjusted basis. So yeah, this is a really interesting chart that, we already saw weakness back in 2021. And again, this is just something that people don't usually see in the headlines. It's just, things are still going to get way worse. US retail sales have not rolled over yet. So we haven't even seen the worst of it, but retail sales on a real basis have been falling for, over a year now, actually. So, yeah, this is a really good chart from Charlie and all the guys over there at Compound. They do a really good job.
Yeah. How could I not put this in the podcast? When I see it, I'm like, I try every week. I'm like, well, I'll try to find something different, but then they hit me with something good. I feel like listeners will like it. So
yeah, well, just a quick market check for people. Again, today is July 21st. Markets are pretty flat after Tesla reported last night. Tesla's up about 5.5%. Defensive sectors, well, it's kind of a mix, are outperforming. You got healthcare, consumer discretionary, consumer staples, and technology all at the top of the board. But going back to talking about commodities, energy is a lagger today, down about 3.5% so far. So I think, next week, I think could be a pretty volatile week with the amount of earnings reports that are coming out, Nick. So
yeah,
again, if people see more swings in their portfolios or their accounts next week, it's pretty normal. Because we have a slew of larger companies reporting their earnings for Q2 of this year.
Mm-hmm. A lot of big boys next week.
Yeah, Apple, Amazon, I think Microsoft, Google,
yeah.
Those names are going to be reported. So
yeah.
So it's a little more volatile week. Don't be surprised. But we will be back with you next week for episode 160. Nick, thanks for filling in again today, and I'm sure we'll have you back pretty soon here.
Yep. Happy to fill in as always.
All right, everybody, have a safe, healthy, and happy weekend, and we'll talk to you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.